it's boring. It's boring because on the second of the month, you look in your bank account, oh my God, there's more money in there.
That's a good kind of boring. Right?
This is the Unbound Entrepreneur, where we are breaking the chains of the limiting beliefs, doubts, and misconceptions that plague so many aspiring entrepreneurs. And this is your host, Joseph Crawford.
All right, Unbound Entrepreneurs. This is your host, Joseph Crawford, and I have a very special guest with me today. His name is Jerry Sanders with First Shield Financial. And what they do is they actually specialize in investing in non-performing as well as performing notes. And so today he's going to give me some insight as to the path that got him there, as well as some investment gold for a lot of you out there who are thinking about going into this business. So Jerry, start out by giving us a little insight into who you are, how long you've been in business, what you guys specialize in, and then we'll take it from there.
All right, sounds good. I thank you for bringing me on. I'd love to talk a little bit about the note business and what we're doing. I got into this, I guess I've been an entrepreneur for about 20 years. And, I started out in corporate, left corporate, and decided I wanted to do my own thing. Been involved in a bunch of different entrepreneurial ventures and ultimately wound up back in real estate. I actually started in real estate many, many years ago doing student housing. When I retired, moved down to Florida, re-engaged in it, started doing some fix and flips. So built up a portfolio of tangible assets. We own mobile homes, we own single family homes, we own mobile home parks, all that kind of stuff. And then one day I started doing rent to owns for some of the properties in my portfolio. And that was what introduced me to what it's like to be the bank. All of a sudden I shifted from having to work on toilets and roofs and all this other kind of stuff to just sitting back and collecting money. That was a great thing. Mama didn't create no fool.
Right.
So did some more research, found out about note investing, and literally started off by buying non-performing seconds.
Wow. That's so I'm familiar with notes and real estate investing. I got my start, as a lot of people know, I got my start in lending. I was a broker, right? And actually I started as a mortgage loan officer, and eventually, became a broker. And so I started seeing the writing on the wall, kind of like you did in real estate. I started seeing that there was a side to this that I was missing out on, and they were making a lot more money than I was. So can you tell me a little more about notes? And then if you can talk about a little bit about the, you say non-performing seconds, right?
Yes.
So talk about a little bit about what notes are, and then what non-performing seconds are.
All right, super. So all of us are familiar. The wild part about notes is all of us are familiar with notes. We just don't realize it. So when you buy your house, you go out, you're working with the seller, you agree to a price of $300,000. Bank says, all right, we'll lend you $300,000. When you sit down at the closing table, you fill out a ton of paperwork, and you're getting writer's cramp. One of those documents is the mortgage, and the other document is a note. What we're buying is that note. The other thing that you'll find, when you get your mortgage, a couple of weeks later, a couple of months later, you get a letter in the mail. Whatever bank it was said your loan has been transferred to or sold to or whatever.
Right.
So in our world, we are the folks that are buying that paper. So everybody's kind of familiar with it, but they don't really know that they've been a part of the note world forever if you're a homeowner.
Right.
So that's how a note's created. And literally we go out and we buy the notes. Historically, notes weren't available to smaller investors. They typically sold to the big banks, the institutions, the hedge funds, and all that kind of stuff. After 2008, it became available to us smaller investors.
Mm-hmm.
So for our company, we'll buy from banks, we'll buy from hedge funds, we'll buy from trade desks, we'll buy from other investors. So that's how the notes are out there. That's how we get them.
Thank you for that, because that's actually it's like 101 notes 101. Like everybody is familiar with them, and most people just don't know how familiar they are. So let me ask you, because we talked about like the first and non-performing. So I'll just kind of throw this out there so I can kind of lead our audience into this. So the first and the second, in short, like a first position or a second position. First position means that if you default on that loan, the person in first position gets paid first when they foreclose on you and they sell that property. The person in second position, they only get paid if there's enough money left over from the sale of that property to pay that second loan. So second position is kind of a scary, touchy area. A lot of investors don't want to participate in that. Could you give some reasons on why you would choose to go in the second position investing?
Yeah, and the wild part is most folks haven't really looked at the legal dynamics of a first versus a second. So many of you know a second is just a HELOC, a home equity line of credit. When you sign that note, that HELOC, you are also pledging your house, just like you're doing with the first lien. The difference is most people assume that the only entity that could foreclose on you is the first. However, if you're making the payment on the first, but you're not making the payment on the second, because you pledged the house on the second, I can foreclose on you.
Yes. And
when I foreclose, I get the deed. Now, I also get the responsibility of having to pay the first mortgage. And, if the first mortgage is current, I may foreclose, take the deed, keep paying the first, move a tenant in there and rent it out. So that's a possibility. I think the big thing is most people don't realize that even in a second position, you can initiate a foreclosure on a house. And we do. We have done that on numerous occasions.
Now, is that like every state has different rules on foreclosure, but from what you've seen, is that a pretty standard across the board in most states that you've worked in, that someone in the second position can foreclose and get control of the property?
Yeah. We've not seen it in any of the states that we're working in. Now, the caveat is that there are some states that are more difficult. We don't buy notes in New York, New Jersey, some of the New England states, because foreclosure in general takes a lot longer than we want to be involved with that note. So, but it's not an issue. It really gets back to the legalities. You took out an IOU, which is the note. You pledge a piece of collateral to back up that note, and now we're trying to collect. And in the collection process, you file for foreclosure.
Yeah. Let me ask you. So obviously, as an investor, the goal is to get a return on your investment.
Yes.
So the ultimate goal is to collect income for most investors. They want to collect income, which is why they would invest in a note. But investing in seconds, that's kind of opening, that's a two-way street, which there's three different outcomes from investing in the notes, and it doesn't matter if it's a first or a second, or it's performing or non-performing. Could you talk about what those three directions or those three outcomes could be if you invest in a note as an investor?
Sure, absolutely. And as you mentioned, there are only three possible outcomes. First outcome, the borrower pays as agreed. We all like that. It's plain vanilla. It's boring. It's boring because on the second of the month, you look in your bank account. Oh my God, there's more money in there.
That's a good kind of boring, right?
Yeah,
that's the boring we all want.
Really boring. I got more money. That's boring. The second outcome is they pay it off early, and that's a good thing for an investor as well, because typically we buy a note at a discount, and when it's paid off early, all of that discount money comes in as well.
So that's like equity in the home, right? Even
Equity
though we're
in the
not
home.
talking about the property, we're talking about the note. That's like equity,
Yeah.
yes?
Yes.
Okay.
And
Right.
that's a great way to look at it. It's like equity in the note.
Okay.
So I bought it for $10 and I got $10 of equity. So when you pay it off, I got $20. Great
Right.
thing. So that works out, and you wind up getting a little bit better return when they pay it off early. And then the
Okay.
final thing that can happen is they fail to pay.
Before you
And
jump into that,
Yeah.
I want you to take a little bit of time on this part, because this is actually for someone who's already an investor, someone who wants to get the maximum amount of return off of a deal. The don't pay option is actually better for us as investors. Is that right?
yeah.
Okay.
Yeah, the don't pay has a lot of benefits. It's Now, remember I said if they pay on time is boring because the money's going to come in, it's just coming in. The second option, they pay it off early, you get more money.
Right.
On the third option, when they fail to pay, it's more work because you're trying to negotiate with the borrower to get them to pay it off. If they don't, you will wind up taking their home. Now, with us, first of all, when we're buying a note, we make sure that there's equity in the home, as well as there's equity in our note because we're buying it at a discount. So if we do wind up going through foreclosure and we wind up taking the house, we're literally taking the house for substantially below what its market value is. So as a result of that, you have a tremendous upside. And when you look at the investment, it is a substantial upside.
So I would say what's most important with any investment, if you're listening, due diligence, right? Like the money is made. Like it's not when you invest, it's not when you get your return if they pay or if they don't pay. The money is actually made in the due diligence before you even sign a contract. Would you agree?
Yep, agreed.
Yeah.
Just like when you're buying any other real estate, you make your money on the buy, and you collect it on the sale. And
Absolutely.
With notes, it's the same thing. You make the money on the buy, and then you collect it when you sell the note or when the note cashes out.
So just for everybody listening, Jerry and I are actually part of a mastermind together with investors who are all looking to do the things that they need to do to make the most on their investments in different directions, and most of it is surrounded around real estate, specifically notes investing. I would like, he and I have talked, and I heard a story of his before that I think it really kind of puts the nail in the coffin on what we're talking about, doing your due diligence up front, as well as how the not paying option, like if that's what happens, if that's the outcome, how it's actually much better for the investor. Yes, there's work that goes into it that nobody really wants to do, but if you're specifically investing in notes that are unperforming or non-performing, then you're kind of looking at this as this is probably going to happen and how you need to handle it. Can you talk about that story of the guy who had the option to take care of the note and just didn't do it? You gave him every option to take care of it. He didn't do it, and how it cost him more money as the homeowner.
So everybody loves this story. We call it the DC story. Normally, I would not buy a note in the District of Columbia because it's a tough place, but we bought. In our due diligence, we're looking at this note. It's a house in an interesting area of town. The borrower had purchased it for a reasonable price a few years back and had about $250,000 of equity. He had a second, which he stopped paying on 10 years ago. So most people forget that when you take out a loan, even though you're not paying, the loan is still accruing.
Yes. Yep.
So when we're doing our diligence, we're looking at this and it's like, this loan has accrued a lot of interest, a ton of interest. The house, like I said, $250,000 worth of equity. I had some folks go over, take a look at it. A family member in that area is in the real estate business. So they went over, they gave me a BPO, which kind of shocked me. So we called the borrower up and, after we bought the note, we tried to engage the borrower. We sent him letters. We called him on the phone. We sent emails. We sent text messages, all of that stuff. I even sent a guy over to his house to knock on the door and say, we got to talk to you. He answered the door very politely, took the package that my guy gave him, thanked him, closed the door, no response. So I figured, all right, you didn't respond to that. Maybe if I kind of tweak you with a little legal thing, you'll move. So we sent him a demand letter, which basically says, hey, your note's in default. Should have been in default for 10 years.
That's a lot of payments.
That's a lot of payments. You owe us some money, and we want to work with you so that you can keep this house. He's an investor. It's an investment home, whatever. He still didn't respond. So, and at that time, I'm thinking, all right, we got a really good discount on this note. I'd be willing to take like 50,000. I would be very happy. I'd have a really fat return on my investment. My partners would be happy. Everybody's happy. 50,000.
And one more time, how much did he owe?
He owed, when we got to court, 92,000.
Okay. And you were going to give him a discount and wipe your hands clean, take 50,000. He wouldn't get a foreclosure, right? Nope. He wouldn't have to pay any court fees. Nope. No attorney fees.
Nope.
And he would be able to walk free and clear and be able to go purchase another house without worrying about a foreclosure on his record, right?
Yeah. Yep.
Okay.
And even if you didn't have the money, he had enough equity in the house. And at that time, interest rates are really low. He could have refied the first and me, taking us both out, had a lower payment, paid off the first, paid me off my 50, and put money in his pocket. So when I looked at the note, that's why I did. I was like, I gotta buy this note because this is a no-brainer. I'm going to help this guy out. He's going to wind up in a much better financial position than he's in when I buy the note. And he just totally ignored me. So, we're kind of disappointed about that. And like I said, we just keep ratcheting it up. And so finally, he's not responding. We file for foreclosure. And, we went through a couple of machinations with that. This is right around the time of the COVID moratorium. But it turned out his house did not apply. The moratorium was not for his house,
right?
Not for this house. And there were some reasons for that, and and I won't get into that. So we filed foreclosure. He still didn't respond. And it's sort of like, dude, you got $250,000 at risk here. Why would you not respond? Because if you don't respond, I get the $250,000. And I don't necessarily want the $250,000. I want to do something. I want you to keep your money. I want to get my money. So anyway, still didn't respond. Judge announces, here's the foreclosure sale. Got a sale date. A week before foreclosure, he files for bankruptcy. And let me back up. One of the other things we looked at before we bought the note, we look at your credit report. This guy had a 680 credit score or something like that.
Okay. No reason to be concerned.
No reason. And he has a bunch of other properties. He has all of this equity. Why would you file for bankruptcy? Just to stop the foreclosure. So then we go to foreclosure court. Judge says how much and how much does he owe? And we were awarded what he owed as opposed to what I was going to discount. So at the end of the day, it's just everything went bad for you, even though we were trying to help you out. So that note was our Super Bowl, our home run. I won't tell you what percentage return we got. It was ridiculous.
So let me ask you this. What did you pay for that note? I think you may have said it.
In the teens.
Okay. So less than 20,000.
Yep.
You offered him 50 to walk away free and clear. So you would have made over 100% on your investment. Well over 100%. He didn't do it. He tried to get clever and filed for bankruptcy, and in the end you got 92,000.
Yeah.
Right. So we're talking at least 500% return, right? Like obviously this isn't something that happens all the time and with every note.
No.
But it's not uncommon to see that situation play out. So earlier we talked about there are 3 ways that you can make money investing in notes, right?
Yeah.
So if they pay, right, then you get mailbox money every month.
Yep.
If they pay early, then you get mailbox money until they pay early, and then you get the balance. So that's a big cash win, right?
Yeah.
A windfall. And if they don't pay, then you foreclose and you could get a cash windfall as well as the property.
Yeah.
Right.
You're gonna get one or the other.
One or the other. Right.
One or the other. Yeah.
So, I mean, as an investor, right? Because the thing is even though investing in notes, for someone who was used to, the toilets, the termites, right, and the tenants, as they say, for someone who's used to that, like investing in notes is like, yo, that's a no-brainer. This is easy. I'll take those problems over these problems any day. Now, obviously, there are reasons why investing in the property itself can be beneficial. There are some tax implications there that can help. I would never say don't invest in any real estate and only notes, but as far as like the hands-on activity and the problems and the things that you deal with, investing in notes eliminates almost all of it. Almost. So for what you guys do, right, at your company, so at First Yield,
yes,
how do you work with investors who are interested in investing in notes, but don't want any of the problem? They want to be completely hands-off, right? Like, because there are people like me who are like, no, I want to do this because it's better than what I was doing. And then there are investors who maybe they have a retirement account, maybe they've already retired and want to do something better with it, or maybe they're full-time, executives or employees. They love what they do. They love their career. They have no interest or no knowledge of being the hands-on investor. How can you help those people get into investing in notes, and what does that look like for them?
Okay. We love working with folks like that. And, one of the things that we can do, if you truly want to be just totally hands-off, we can buy a note with you, and we do something called a hypothecation, where we will go out, we will work, we have an investor, we'll find a note that meets their criteria that will give them a return. And we will buy that note. It'll be in our name. We will assign that note to that investor, and they get a monthly payment.
Okay.
We'll get a little piece of that off the top. A couple of percentage points per month off of that payment as well. But they get that payment for the duration. If it turns out that we were to default in some kind of way, then they step in our shoes and take the note. So, it's a really easy process. It's a good way to get into the note business, particularly if it's money coming out of one of your retirement accounts, so that you get this consistent monthly payment, passive income with no real work on your part. We're doing all the work, managing the borrower to make sure that the money gets paid.
Perfect. Look, Jerry, I just want to say thank you, and everybody that's watching, if you are interested in investing in notes, I'm actually going to put a link under this video in the description that will allow you to get in touch with First Yield Financial. You can learn more about investing in notes, what it would look like for you, how that partnership works. It's more of a done with you partnership where they take on the load of actually doing the work, handling the legal parts, and and everything like that. So you don't have to worry about it. You can just sit back and collect that mailbox money that we were talking about. Again, it's First Shield Financial, Jerry Sanders. Thank you again. His link will be in the bottom. And everybody listening, have a great day. And thanks for joining us here at Unbound REI.
All right. Thanks for having me.
Absolutely. Thank you.
Bye-bye.